If you've traded long enough, you already know the truth. The market doesn't give a damn about your hopes, your feelings, or your ambitions. It responds only to pressure. Buying pressure, selling pressure, and the momentum created when one outweighs the other. Every trader who survives long enough learns this, and the sooner you learn it, the less tuition you'll pay to the market. I spent years learning that lesson the hard way. I made fortunes, and I lost fortunes. And if there's one thing I can tell you from experience, it's this. The market rewards discipline, not excitement. It rewards clarity, not scattered impulses. It rewards the man who waits for confirmation, not the one who guesses. Today, I want to break down a method that forces discipline, trading price through the lens of moving averages on the 15-minute chart. Not because moving averages are magical, they aren't. No indicator is. But they impose structure on your trading. They eliminate decisions made on impulse. They help you distinguish noise from momentum. And momentum is where the money is made. The market will often try to convince you that a reversal is coming. A trap here, a fake spike there, a momentary flicker of enthusiasm. But when you anchor your decisions to clear, mechanical signals, you sidestep most of that trickery. You operate like a professional patient, practiced, and precise. That's why the moving average strategy works. Not because it predicts the future, but because it keeps you from making foolish trades when your mind wants to gamble. Let's start at the beginning. Why the 15-minute chart? Because it's slow enough to filter out the noise of the 1-minute and 5-minute scalpers who are just chasing movement, but fast enough to give you multiple trades in a session. It's the sweet spot between chaos and opportunity, the one place where you can witness the real battle between buyers and sellers without being overwhelmed by meaningless fluctuations. But before we talk entries and exits, I want to talk psychology, because strategy without discipline is just wishful thinking. When I started, I believed that intelligence could beat the market, that if I stared long enough, studied hard enough, calculated perfectly enough, I could outsmart it. But intelligence loses every time to emotion. Fear and greed overpower logic. You start seeing what you want instead of what is. The market punishes that. The moving average strategy becomes powerful only when you accept that you don't control the market. You control nothing except when you enter, where you exit, and how much you risk. That is it. And if you can master those three things, you can make a fortune with something as simple as 2 lines on a chart. Let's get into those lines. For this method, you'll use 2 moving averages, one fast, one slow. The fast average tracks short-term momentum, the heartbeat of the market. The slow average reflects the broader direction, the march of the troops. When the fast crosses above the slow, it's telling you that the battlefield has shifted. Buyers are stepping in with strength. When it crosses below, sellers gain control. Now listen carefully, because this is where most traders get it wrong. They see a cross and sprint into the trade like children chasing a coin in the street. That impatience is how accounts die. A moving average cross is a signal, not a command. It's a whisper, not a shout. It alerts you to a potential change but doesn't guarantee one. You wait for price to confirm the shift. Confirmation separates the gambler from the operator. Here's how the method works. When the fast average crosses above the slow, you don't buy yet. You observe. You wait for price to trade above both moving averages and pull back into the zone. A pullback is the test. It tells you whether the momentum is genuine or just a head fake. The market has a habit of shaking out eager traders before the move truly begins. The pullback exposes weak hands. It tells you whether buyers have the conviction to defend the new direction. If they do, price will hold above the slow average and bounce. That bounce is your entry. Not the cross, not the first candle, not the emotional spike, the bounce. The bounce is the market saying, yes, the direction has changed. Now's the time. Your stop goes below the pullback low. Not because stops are magical, but because if price breaks that level, buyers have lost control and you were wrong. That's all. No drama, no panic. Just exit. Accept it and move on. Now, how do you take profit? You can aim for a set multiple, 2 times or 3 times your risk, or you can ride the trend until the fast average crosses below the slow. Both methods work if you stay consistent. Consistency is the real strategy, not the lines themselves. Let's talk about the other half, the sell side. The rules are the same, just in reverse. When the fast average crosses below the slow, sellers are asserting dominance. You wait for price to trade below both, pull back toward the averages, and reject. That rejection is the market's confirmation. Enter there. Put your stop above the pullback, ride the trend down. This strategy works not because the moving average cross is magical, but because it forces you to align with the dominant pressure. It prevents you from fighting the trend. Fighting the trend is how traders lose fortunes. I've done it. I've tried to grab reversals. I've tried to be clever. Cleverness impresses nobody in the market except the broker collecting your commissions. Trade with the pressure, not against it. But there's another layer, far more important than the strategy itself, your emotional discipline. When you trade on the 15-minute chart, you're going to watch price fluctuate in ways that tempt you to abandon the plan. The pullback may look too deep. The candles may move too fast. The cross may come later than expected. The market's movements will play with your nerves, and that's when most traders break. They chase the candle, they skip the pullback, they widen their stop, they close too early. If you do any of that, you're finished. Let me tell you something I learned after years of trading. The best trades are uncomfortable. The market rarely gives you perfect entries that feel safe. It rewards those who can sit through the discomfort of waiting for their moment. It rewards those who can wait through the pullback without flinching. The pullback is where your discipline is tested. It's where weak traders lose their nerve. It's where strong traders prepare to strike. And if you want consistency, you must be strong. Now let me address something even more important. Risk. You will lose trades with this strategy. If that bothers you, you have no business in the market. Losses are part of the game. They're the cost of participation. The professional's job is not to avoid losses. It's to manage them so they don't wipe him out. Risk 1% of your account per trade, 2% at most. Anything beyond that is gambling. The market has wiped out stronger men than you for risking too much. It wiped me out early in my career more times than I care to count. Don't repeat that mistake. A losing trade is acceptable. A blown account is not. Now, let's talk about the mental traps traders fall into with this method. The first trap is entering before confirmation, jumping in the moment the cross happens. That urge comes from impatience, fear of missing out, and greed. And the market knows how to punish all three. The second trap is taking every cross as if it's a guaranteed trend. It isn't. Sometimes the market chops, and the averages cross back and forth like tangled rope. In those conditions, you don't trade. You wait. You preserve your capital for when momentum returns. The third trap is widening your stop to give the trade room. That's emotional trading. Your stop belongs where the setup breaks. Anything beyond that is self-delusion. The fourth trap is taking trades in the middle of nowhere when price is stretched too far from the averages. The farther price is from the moving averages, the closer it is to snapping back against you. You trade from the pullback, not the extension. Now let's go deeper into the logic behind this strategy so you understand the why, not just the how. Moving averages smooth out price, removing the noise and exposing the underlying direction. The fast average reacts quickly to new information, while the slow average filters out the smaller swings. Their interaction reveals shifts in momentum. When momentum aligns with confirmation, you get probability on your side. Trading is nothing more than stacking probabilities consistently. You're not trying to win every trade. You're trying to win over the course of months and years. When the fast crosses the slow, that's phase one, the hint. When price pulls back and holds above or below the averages, that's phase two, the test. When price bounces in the direction of the cross, that's phase three, the entry. 3 phases, 3 steps, no shortcuts. If any step is missing, you don't take the trade. Period. Discipline is the real indicator here, not the lines. The 15-minute chart gives you enough clarity to see the structure and enough time to make decisions without panic. It's a rhythm, smooth, steady, predictable, but it only becomes profitable when you approach it with respect. Here's something else you must understand. Markets change. A pair that trends beautifully one week may chop the next. A stock that rides its moving averages like loyal rails may abandon them the following month. Your job is to adapt. The strategy is solid, but you don't force it on a market that's not trending. When the moving averages flatten, when the cross happens inside a tight range, when price keeps whipping above and below the lines, step aside. Your edge is gone in those conditions. The best operators were always selective. They waited for their moment. They traded only when conditions favored them. The rest of the time, they did nothing. Doing nothing is a skill most traders never develop. Let me tell you a story that illustrates this. Years ago, I watched a stock drift sideways for hours. Every amateur trader around me was trying to scalp small moves, chasing every flicker of movement. I waited. Hours passed. They grew impatient. Some left. Some took small losses. Some forced trades out of boredom. Then suddenly the stock broke out of the range with force. The moving averages crossed, price pulled back cleanly, and the momentum was unmistakable. I took the trade. It ran for days. One trade. That one move paid more than all their frantic scalping combined. Patience pays more than intelligence. Now let's talk about scaling. Once you master the basics of this method, you can scale into the trend on each valid pullback. Not recklessly, strategically. Each new position should only be added when price respects the moving averages again. But never scale into losers. Averaging down is financial suicide. Losing trades must be cut quickly. Winning trades can be built upon. That's the operator's mindset. Let's go deeper into mindset, because this is where traders truly fail. When you trade the moving average strategy on the 15-minute chart, you must detach emotionally from the outcome of any single trade. Your identity cannot be tied to wins or losses. You must operate like a machine, cold, precise, unbothered. When I lost, I didn't blame the market. I blamed my own impatience or lack of discipline. When I won, I didn't celebrate. I reviewed whether I followed the rules. That's professionalism. Now here's a truth you need to tattoo into your brain. The market will always offer you opportunities, but it will not reward your desperation. If you're trading because you need to make money today, you're already dead. The market senses weakness. It feeds on emotion. It devours traders who push too hard. Trade the setup, not the urge. Let's go through a full example so you understand the flow. Imagine price is trending downward, moving averages aligned with the fast below the slow. Suddenly, the fast average begins to curl upward. It crosses the slow. Amateurs jump in. Professionals wait. Price pushes above both averages. Still not the moment. Then it pulls back into the zone. Sellers attempt to push price lower but fail. A bullish candle forms, rejecting the averages. That's the signal. You enter. Your stop goes below the pullback. Price climbs. The trend strengthens. The fast pulls away from the slow. You trail your stop under higher lows or simply wait for the fast to cross below the slow. Eventually, the cross happens. You exit. The method is simple, but simplicity doesn't mean easy. The challenge is sticking to it relentlessly, without letting fear or impatience take control. Another example. Price is in an uptrend. The moving averages are aligned beautifully. Then the fast average begins to fall. It crosses the slow. Price breaks below both. A pullback tests the averages from underneath. Sellers defend it. A bearish candle prints. That's your entry. You enter. Your stop goes above the pullback. Price falls. You ride it until the next cross. That's how fortunes are made, not by guessing tops or bottoms, not by predicting, but by reacting intelligently to what the market confirms. Let's talk about what not to do. Do not enter without a pullback. Do not trade crosses inside a tight sideways range. Do not widen your stop because it might come back. Do not take trades because you're bored. Do not risk more because you feel confident. The market punishes arrogance. Now, something traders often overlook: time of day. The 15-minute chart moves most cleanly during high liquidity sessions. Avoid low-volume chop. Stick to the windows where real players operate. Let them create the move, you just ride it. One last thing, your journal. If you don't track every trade, every mistake, every pattern, you're walking blind. Professionals keep records. Amateurs rely on memory. When you combine a mechanical strategy with disciplined execution, strict risk management, and emotional neutrality, you become dangerous. You become consistent. You become the kind of trader most only pretend to be. The moving average strategy on the 15-minute chart won't make you rich because it's special. It'll make you rich because it forces you to follow rules. Rules protect you. Rules guide you. Rules keep you from stepping in front of a train, and if you follow them, the market will eventually reward you. If you break them, the market will take everything from you. Trade with clarity. Trade with discipline. Trade with patience. The moving averages will show you the direction, but your discipline will decide your fortune.